Do you want to build long term wealth and get paid while you wait? Sounds pretty good, right? Then you're in the right place. Today, I'm breaking down four rock solid dividend ETFs, each with a 10-year return over 100%, a long history, and payouts you can count on, built to last through the ups, the downs, and everything in between. Not all dividend ETFs are created equal, but the four I'll be going over shortly have delivered big over time. And we'll even look at how you can invest in more than one without significant concerns of overlap between the funds. To come up with this list of solid dividend ETFs, I had to narrow the field down significantly based on specific criteria. Our first requirement is that each ETF has existed for at least 10 years. These funds have survived market cycles, bull runs, corrections, and even full-blown crises, and still deliver strong performance. The next requirement is that each ETF have a total return of at least 100% over the last 10 years. These ETFs have more than doubled investments over the past decade, proving they deliver both income and long-term growth. Our next requirement is that each ETF have a dividend yield of at least 3%. This allows us to generate meaningful income that's well above the S&P 500 average, making them powerful tools for cash flow and reinvestment. Next up, fees. We're not here to give our returns away. Every ETF on this list charges under 0.5%, with most well below that. Lower fees mean more of your money stays invested. Every ETF on this list keeps costs under control, with the highest coming in at 0.38% and the lowest at 0.06%. And finally, we want the heavy hitters, ETFs with over $10 billion in assets. You know, the ones that don't flinch when the market gets weird. ETFs with over $10 billion in assets have widespread investor trust and strong institutional backing. That kind of scale usually means better liquidity, lower trading costs, and a lower risk of the fund being shut down, making them more reliable for long-term investors. Bottom line, these four ETFs have proven themselves through all kinds of market conditions, delivering a solid mix of growth and income. So let's kick things off with the first one on the list, iShares Core High Dividend ETF, with the ticker symbol HDV. Some of HDV's top holdings are companies like ExxonMobil, Johnson & Johnson, AbbVie, Chevron, and Procter & Gamble. It tracks against the Morningstar's Dividend Yield Focus Index, which tracks a high dividend-weighted index of 75 high-yielding U.S. equities screened for high earnings potential and dividend sustainability. HDV has been around since March of 2011, and while it has the lowest 10-year total return of the group at 117%, that's largely due to its ultra-low beta of just 0.67, making it the most conservative and stable option on the list. Quick reminder, beta measures volatility, basically how dramatic your ETF gets when the market moves. A beta of 1 is I go where the S&P goes. Below 1, think chill. Above 1, buckle up. Currently, HDV has a dividend yield of 3.54% and a very low expense ratio of 0.08% and assets totaling around $11 billion. HDV focuses on high-quality companies with strong balance sheets and dividend sustainability. It's the least volatile of the group, great for conservative, income-focused investors. And just a heads up, if you're curious about SCHD, which we'll cover later, I've got a full video that breaks down what makes it such a fan favorite. I'll link it up top and in the description below. Up next, we have Spider's S&P Dividend ETF with the ticker SDY. Some of SDY's top holdings are well-known companies like Verizon, Chevron, Realty Income, Texas Instruments, and Pepsi. It tracks against the S&P High Yield Dividend Aristocrats Index, which is a yield-weighted index of dividend-paying companies from the S&P 1500 Composite Index that have increased dividends for at least 20 consecutive years. SDY started trading in November of 2005, and over the last 10 years has had a total return of 128% and is less volatile than the overall market with a beta of 0.81. Currently, SDY has the lowest yield of this group at 3.22%, an expense ratio of 0.35%, and almost $20 billion in assets. SDY is a top choice for investors who value reliability and consistency. It follows the dividend aristocrat approach, focusing on companies that have raised their dividends for at least 20 consecutive years, and leans toward mid-cap value stocks, giving you a blend of stability, income, and long-term growth potential. Our third dividend ETF on the list is our second from iShares and is their Select Dividend ETF with the ticker DVY. When you look at some of the top holdings for DVY, you see companies like Altria, Ford, Pfizer, Edison International, and Eversource. It tracks against the Dow Jones U.S. Select Dividend Index, which is a dividend-weighted index of around 100 U.S. stocks selected for their yield from a broad universe of companies. DVY is kind of the old soul of this group. It's been around since 2003, pays solid income, and skips the flashy tech stocks. It's more utilities and industrials, less Silicon Valley vibes. Over the last 10 years, it has a total return of 137% and comes in with a beta of 0.79. DVY has a dividend yield of 3.72%, the highest expense ratio of the group at 0.38%, and $19 billion in assets. DVY focuses on high-yield companies in sectors like utilities, industrials, and financials, making it a great choice for income-focused investors seeking strong yields and broad sector diversification without heavy exposure to tech. And our final dividend ETF on the list, and arguably the best of this group, is Schwab's U.S. Dividend Equity ETF with the very well-known ticker of SCHD. Some of its top holdings are Verizon, Coca-Cola, Lockheed Martin, Home Depot, and ConocoPhillips, and it's based on the Dow Jones U.S. Dividend 100 Index, a market cap weighted index of 100 dividend-paying U.S. equities. SCHD is actually the youngest of this group, with it trading since October 2011. And over the last 10 years, SCHD has an astounding total return of 182%, clearly outpacing the other very solid ETFs on this list. It has a beta of 0.82 and the highest dividend yield of the group currently at 4.02%. It has the lowest expense ratio of the group at 0.06% and is by far the largest ETF on this list with $67 billion in assets. SCHD stands out by combining impressive dividend growth with long-term total return potential, offering one of the best blends of income and performance you'll find. It's no surprise it's become one of the most popular and trusted dividend ETFs on the market. Now, you might be wondering, how do these dividend-focused ETFs stack up against a broader market like the S&P 500 over the last 10 years? None of our dividend ETFs beat the S&P 500 on raw return, but they bring something the index doesn't: better income, lower volatility, and fewer stomach-churning drops. And for income-focused or risk-conscious investors, that trade-off can be more than worth it. You're gaining steadier cash flow, lower volatility, and a portfolio that's built to weather market swings. And what's even better, you don't have to choose just one of these ETFs. Let's look at how much they actually overlap and why combining a few might be a smart move. If you're wondering what ETF overlap is, it's what happens when two funds hold a lot of the same stocks. A little overlap's no big deal. Think of it as diversification with a twist. But too much, and you're just eating the same slice of the pie over and over and over. Here's an overview of the overlap between each of these ETFs. For me, as a general rule, if two ETFs share less than 25% of the same holdings, you're probably getting enough variety to justify holding both. But once that overlap climbs higher, especially if it's over 50%, you're mostly duplicating exposure, and that could mean less diversification and more redundancy in your portfolio. So if I felt really strong about having two of these ETFs in my portfolio, I'd lean towards the SCHD and SDY combination, with the overlap being less than 20%, and definitely steer away from the SCHD and HDV combination creeping near a 40% overlap. So which of these great dividend ETFs is right for you? Is it HDV with a focus on financially healthy, high dividend companies? It's a great pick for income investors who want lower volatility and steady payouts. Or maybe it's SDY, targeting companies that have raised their dividends for 20 plus years. Its mid-cap value tilt offers long-term consistency and a slightly different flavor than most large-cap dividend funds. Or how about DVY and its solid income by leaning into sectors like utilities, industrials, and financials? It's a smart option if you're seeking yield with less exposure to tech. Or maybe it's the ultra-popular SCHD, which stands out with a powerful blend of dividend growth and total return. It filters for quality and financial strength, making it a top-tier core holding for long-term investors. Or maybe you're feeling bold and want to If that's the case, SCHD and SDY would make an excellent duo. With only 19% overlap, you get SCHD's growth-oriented quality dividend exposure alongside SDY's dividend, aristocrat, consistency, and mid-cap tilt. Together, they offer diversification across size, strategy, and stock selection without stepping on each other's toes too much. Well, there you have it. We've reviewed 4 great dividend ETFs that could be a great addition to your portfolio. Let me know in the comments, are you invested in any of these? Or were there ETFs you've never really heard of outside of SCHD? If this breakdown helped you make sense of your dividend ETF options, tap that like button, subscribe for more no-hype investing content, and hey, maybe even share it with a friend who thinks dividends are boring boomer stuff. As always, thanks for watching and hanging around till the end. Remember, I'm here to make content focused on your money and how to manage it best. See you in the next one.